Hello friends. One of the important analysis what we have to do in the stock market is to value a stock and how to do valuation. So today we are going to talk about a valuation matrix called P ratio and we are going to go into detail and let us see how we can compare that with various stocks. So particular stock need to be compared with other stock. So how we can compare it and how we can decide which is the best stock possible to buy. So friends, I welcome to my YouTube channel. My name is Tapan Doshi, and if you are not subscribed to my YouTube channel, just click below link and do subscribe it and like this video. So guys, let us go into detail and see how you can use PE ratio. So let me take one example first. So let us talk that let us say that there is one company called ABC. Okay. Now this is the P&L. The sales is around 20 crores. Okay. Now what is COGS? COGS is nothing but cost of goods sold. That is around 10 crores, which is 50% of sales. So the gross profit comes around 10 crore. Now administrative cost. What is administrative cost? Administrative cost is nothing but whatever admin cost incurring in the company. So that is around, here it is uh, 1 crore. Okay. And S&P is around 75 lakhs. Similarly, rental is 75 lakhs. In S&P, we covered selling and promotion expenses and whatever related to advertisement and everything. And also in rentals, we cover whatever rentals we are going to pay for office, warehouse, and everything. So that is covered into rentals. That is around 75 lakhs. And depreciation. Now, what is depreciation? Depreciation is nothing but suppose you buying an asset like a computer. Okay, now when you buy an asset, you have to depreciate within years. And as per companies like they say, suppose you have to depreciate computer in next 2 years or 3 years, then you have to accordingly depreciate that asset in next 2 years. So that is 50%, 50%. That is what depreciation is, which is around 1 crore. So the operating cost around comes around 3 crore 50 lakhs rupees, which is nothing but 70.5% of total sales. Now, what is after deducting gross profit minus operating cost, you get NPBT. What is NPBT? Net profit before tax. Now, net profit before tax is nothing but what before tax, whatever profit you are getting. Okay, so it is around 6 crores 50 lakhs rupees. And tax is suppose we assume the tax is around 30%. So the tax will be around 1 crore 95 lakhs rupees. So what is NPAT? So NPBT minus tax is NPAT, that is net profit after tax, which comes around 4 crore 55 lakhs, which is 22.8% of total sales. So this is our net profit after tax. Now what is the EPS formula? EPS formula is nothing but net income minus preferred dividend, whatever dividend we are going to pay, divided by outstanding shares, whichever is floating in the market. Okay. So here our net income is nothing but 4 crore 55 lakhs rupees minus 55 lakhs rupees. Suppose you are considering as a dividend you have paid and divided by 10 lakh shares. Okay. Now 10 lakh shares is nothing but total shares outstanding in the market. So EPS we got here is around 40 rupees. Now let us see what is market price. Okay, so the market price is nothing but price going floating, sorry, basically whatever showing in the market. Okay, every day whatever market is showing, that is a market price. That is, suppose it is 600 rupees. Then what is P ratio? P ratio is nothing but total price, that is market price, divided by EPS, that is 600 divided by 40. Okay, so it comes to around 50. So the company, for a company ABC, the P ratio is around 50. So what is P ratio? P ratio is basically how much multiple of profit you want to pay for buying that shares. Correct. So basically that EPS is 40, but you are going to pay, you basically a buyer actually currently paying 15 times of that EPS in order to buy that share. That is called a P ratio in a layman language. So guys, now basically after learning this P ratio and EPS, let us see what are the various types of the EPS. Okay, so the first type of EPS is trailing EPS. Trailing EPS is nothing but last 4 recent quarter EPS. So for example, for this year, it will be from 1st April to 31st March. Okay, that is 1st April 21 to 31st March 2022. Now, what is the second type of EPS? Second type of is nothing but current year EPS. Current year EPS is nothing but part actual plus part projection. So, for example, the current, like this is currently May 22. Okay, so the for the example, we take April 22 to June 22 as an actual, and plus you have to add July 22 to March 23 as a projection if you want to consider as a current year EPS. Okay. And third part is nothing but forward EPS. Now, what is forward EPS? Forward EPS is nothing but earning estimates of the future year. Okay. So, for the current year, this is current year financial year 2023, 22-23. So, the forward EPS is nothing but like financial 23-24 EPS, financial 24-25 EPS, and financial year 25-26 EPS. So, these are the three type of EPS in the market in the basically finance terminology. Now let us see what are the various types of P ratios. Okay. So first type of P ratio is nothing but trailing P. Now what is trailing P? Trailing P ratio is nothing but dividing the current share price by the total EPS earnings over the last 12 months. Okay. That is called a trailing P ratio. So are you getting the current price whatever is there, and P ratio, basically EPS of the last 12 months. Okay. If you divide that, then you are getting a trailing P ratio. Similarly, second is forward P ratio. Forward P ratio is nothing but dividing the current share price by the future earning. Okay. So normally that is used for the valuation metric, that if you divide the current price by the future earnings, then you are getting a future P ratio. And third important is median P ratio. Now, what is median P ratio? Median P ratio is nothing but average P ratio of the last 3 years. So, whatever last 3 years you have PV ratio, you can take an average of it. That is an average P ratio of the last 3 years. So, now let us see how we can compare various companies through P ratio. So let us take an IT company's example. Suppose this TCS currently, the current market price TCS is 3417, EPS is 105, and PE is 32.5. Similarly, for Infosys, the market price is rupees 1526, EPS is 53, and PE is 28.8. And for the Wipro, it is market price is 475, EPS is 22, and P ratio is 21.6. Now let us compare each other. So for the TCS, the price is high and also P ratio is 32.5. However, the price of Infosys is 1526 and Wipro is 475. Now, normally what the retail investor do think always that the higher the price, the more expensive that stock is. Well, it is not true. The reason is simple, that you don't have to compare with the price of the stock, because that depends on various factors. Basically, how much the stock is floating, basic value, number of shares in the market. That also is a dependent, one of the main factor through which you can come to know whether the market price is higher or not. Reason is if the float is less, the market price may be on a higher side. The main thing is that you have to consider what is the EPS. Okay. Now EPS also here it is 105 and here EPS is 53. But if you see the P ratio is nothing but market price divided by EPS, that is 32.5, and here it is 28.8. However, if you see that P ratio of TCS is higher than the Infosys, correct? However, if you see Wipro market price is 475, the EPS is 22, and P ratio is 21.6. Though Wipro prices is much lower, okay. However, the P ratio is also lower. Now, that does not mean that Wipro is a good stock. See, many times whether the particular company, how it is going to perform in future, that is also one of the main determinant to whether the extra premium is given to that stock or not. Here, the visibility of earning is much better in TCS, then the market may give them a higher P ratio compared to the Wipro PE ratio. Okay, Wipro PE is 21.6, but market participants may think that there will be less growth in that stock, so they may give a less P ratio to that. Okay, so this is how it is decided. So TCS is 32.5, Infosys 28.8, and Wipro is 21.6. Now let us see what is the IT sector P ratio. Why? Basically, you have to compare that stock with the sector P ratio also. So the sector P ratio is 29.5. Correct. Now this 29.5 is nothing but a sector P ratio. Now, if you see, then Wipro is actually 21.6. So it is lower than the IT sector P ratio. That means it is undervalued. Over. But you then you can say TCS is overvalued and Infosys is normally a properly valued stock. Well, it is not the TCS. If it is performing well, they may get an extra premium for that. Okay. Also, you can compare with the Nifty P ratio. Here, the Nifty P ratio is around 19.9. Okay, so anyways, the IT sector is getting much more better valuation favorable by the market participants because there is an extra premium, and reason the growth visibility in IT sector is much better compared to other sector. That's why it is given better P ratio to that stock. Okay, basically extra premium they are giving. Now let us see another metrics. Suppose if these stocks are not performing well and all that, then how you can whether decide how you can decide whether the future visibility is good or not through one of the another important better ratio is available in the market, that is PEG ratio. Now, what is valuation through comparison to PEG ratio? PEG ratio may be used whenever there is a basically you don't know how the growth prospects of the two companies in future. Okay, so if a particular stock valuation is on a higher side, you can use this PEG ratio. Or if the company is loss making, you can use this PEG ratio because PEG ratio cannot basically P ratio cannot be used for the loss making company. So what is PEG ratio? PEG ratio is like earning growth. Okay. So what is P ratio divided by basically P ratio divided by annual EPS growth. So okay. So here if the PEG ratio is less than 1, then it is favorable. So suppose the P ratio is 50. Okay. And the EPS growth is 20. Then the PEG ratio is 0.75, which is good. Now annual EPS growth is nothing but EPS growth. Okay. And P ratio. So 15 divided by 20 is 0.75, then it is favorable. The problem is this type of company is not available, means very few companies have a PEG ratio less than 1. So that is why a company less than 2 PEG ratio is also good for basically you can consider good for purchasing that stock. Basically 2 PEG ratio is also good. The reason is simple that currently the stocks are not available which are having less than 2 PEG ratio. Okay, so you can consider that also company for purchasing. So guys, this is how you can use P ratio and PEG ratio in order to value in order to compare with one another. And this is a very important matrix to consider. Reason is simple. It can be applied in many sectors. However, I am not saying that everywhere these matrix is applied, but if you apply this through across the sector, it is quite useful. So guys, hope you like this video. Please like this video by clicking the like button, and I see you in the next video. Thank you.